Namaskar. In this special series of BSE IPF for the year 2020, which was the theme is the year of a crisis and the lessons of a lifetime, 8 videos are done. Last 2 videos we are talking about. We have listed the learnings from each of these videos. So if you watch the series, we hope you will find it useful. In this video, we are going to talk about this IPO mania. I mean, loss-making companies, they got oversubscribed. They listed at 100% premiums and they hit upper circuits, and all that in a year where there was global lockdown and the Sensex hit lower circuit just barely a few months back. So it's that kind of a year. What has led to this IPO mania is, like we saw last time, when the discount rates are low, when the interest cost is low, that translates into low cost of capital. That was the previous video. In this video, we will understand that these low interest rates translates into high present value. So again, that risk, why companies are listing at such high premiums. We need to understand two opposite things, because RBI is doing something that's also very interesting. It's all about yields and prices. So let's understand the first IPO mania part. Let's say there is a company, or let's say you want future cash 108. After 1 year, you want 108 rupees. And if the interest rates or the discounting factor is 100 rupees, 8%, then present value is 100, which means today you will have to invest 100 rupees at the rate of 8% for a period of 1 year, so that in future you will get 108 rupees. This is simple. Now let's say you say, I still want 108 rupees. Okay. But interest rates have come down due to this global liquidity and all, and RBI has reduced these interest rates. So because of all of that, because interest rates have come down, now if you use the PV function or the present value function, it means you will have to now invest slightly more than 100. Why? Because your money will rise slowly and you still want 108. But because and in the same time period, 1 year, so because your target is same, because your time period is same, but just because interest rates have come down, it means today you will have to invest more. Now, having understood this, let's try to understand the price of a financial asset is the sum of present values of all future cash flows. So here in this case, if this is a company which was going to make 108 rupees profit, pay attention, if this was a company which was going to make 108 rupees profit, which anyways now also it will make 108 only as the profit. But if your discounting factor has come down from 8 to 6, then it means that very simplistically, we are not putting the PE and the M caps and stuff like that, but it means that earlier if the price of the stock would have been 100 rupees, today it will be 101 rupees or close to 102. Why? Just because the discounting rate has come down. So all future cash flows are getting discounted at a lower rate, and therefore the present value is increasing, and therefore we see this huge rally in the stock market. So we have seen what in the previous video, low cost of capital, that's good for the stock markets. In this video, what we are seeing, that low discounting factor translates into theoretically high present values, I mean stock prices. This is the second thing which we learn from this crisis. Now this whole point of price and value, we will turn around its head, because the same thing, because an opposite thing also happened during the same period. IPO mania happened because global liquidity is down. Prices went up because the discounting factor is down. Global liquidity is up, and because of that the cost is down. So IPOs are getting huge prices because the interest costs are low. Now RBI did something known as Operation Twist. And RBI did something known as Operation Twist, in which RBI sold less than 1 year bonds, 10,000 crores tranches, and RBI bought long duration bonds. Now why did RBI buy long duration bonds? Again, to reduce the long term yields, because if you see in the year 2020, this red line, which is the short term yield 3 month, and black line, which is the long term yield, In the year 2020, after RBI came in, these red line crashed, but the black line remained where it was, or it didn't come down as much as RBI would have liked. So RBI is trying all it can to pull this down, so yield it wants to bring down. And how it is trying to bring the yield down? By increasing the prices. How it is increasing the prices? By buying these bonds. So earlier, if let's say for a 100 rupee bond is paying 6%, RBI is trying to create demand for that bond, and because of that, if the price increases to let's say 105, then earlier an investor would get 6 rupees on paying of 100. Now he will get 6 rupees on paying of 105, and that means the rate of interest would be 5.71, which will be less than 6. So this yield would have come down. So try to understand, in the same 1 year, two opposite things happened. One, IPO mania happened because the rates went down. Both the things are happening because of liquidity. Appreciate that. There is huge liquidity available. So because of that huge liquidity available and the discounting factor is going down, IPO prices are getting listed at 100% premium. So here, because the discounting factor is down, the present value is high. What RBI is trying to do? Trying to increase the price so that the yield comes down. Opposite cause. What is the cause in one case is becomes the opposite in another, and this is the beauty of finance. So hope you are understanding these small things from these videos. Yield spreads increased because of liquidity crisis. Sensex went into bear hug, lower circuit. Dollar and gold are assets which people like in times of crisis. RBI provides liquidity, but still strong companies only remain stronger, have emerged stronger. Not all companies have performed. You should be able to separate diamonds from coal. If you can't do that, then stick to index funds, do daily SIPs, buy diamond at the price of coal. Liquidity works, SIP, STP work best, especially during low times. And then this session learning, high liquidity leads to more risk capital. Each IPO is not probably meant for you. You have to know, even if it gets oversubscribed, even if it lists at a phenomenal premium, you should ask yourself a question: am I ready, or am I able to take the risk of this? If yes, fine, go ahead with it. But otherwise, don't be blinded by this price, because risk is getting mispriced due to high liquidity. Always keep in mind. So in fact, that's the objective of this entire effort by BSE, IPF and SEBI. I mean, online became the main thing because of pandemic. This online series started because of this pandemic only. So the effort is that don't take investment decisions without understanding. So 9 videos are over in this 10 video series. Last video coming up, that is about what the RBI feels about Indian economy. So thank you very much for watching this video series. Watch all the 10. So there will be, we hope you learn, you find it useful, and in the comments thank SEBI and thank BSE. Thank you very much.